Hello, in this video, I'm going to talk about the blockchain, which is the most important thing really in Bitcoin, and it's the key innovation. The things that I talked about in the previous video, such as digitally signing transactions to prove that you actually own the money, that has been around for a long time. People were able to do that before Bitcoin came around. The key piece I was missing was a way of ordering transactions in time. And this is what the blockchain does. So what are the problems we're trying to solve? Why do we need the blockchain? Well, it's to avoid that the same money is being spent twice. So for instance, the signing of a transaction is what makes sure that somebody else can't spend my money. However, the digital signature doesn't prevent me from trying to spend that money twice or more times. Another issue that we have to tackle is how do you create a motivation for participants in the network to add transactions to a block? So block is part of the data structure where we're storing transactions. And how do we get people to bother to verify transactions? How do you get the participants in the Bitcoin network to verify other people's transactions? How do you make it be something for them? We do this with the blockchain, which is basically a data structure stored on a hard drive where we have hashed each a block so it's uniquely identified. Now, what does each block contain? Well, the first piece of information is a reference to the previous blocks. We're pointing to the hash of the previous block. And of course, it contains all the individual transactions that have been included in the block. An interesting thing to note here is that each block is of a fixed size. At the moment, when I'm talking about this, it's 1 megabyte. So you can't fit more transactions than that into the block. And this is a contentious issue and is what has caused a fork where you have Bitcoin Cash that has a bigger block. I'm going to get to that a bit later. Another piece of information, which is quite important, is called the nonce. Now, the nonce doesn't really represent anything. It's just a number. But the creator of the block can set this nonce to anything. Now, why does that matter? Well, it's because when you're changing the nonce, you're also changing the hash of the block. So it's a way of manipulating the hash of the block. So putting this together, we get this chain of blocks that all contain a nonce and transactions. The point of this is to agree on the order of transaction. Now, to get you to think about this question, think about how would you actually do this. The naive approach would be to vote on transactions using the IP address of the participants in the Bitcoin network. However, this would obviously not work because an attacker could masquerade as multiple users by just registering an abundance of IP addresses. So this is where the brilliant solution that Satoshi Nakamoto came up with, the creator of Bitcoin. He devised a scheme called proof of work. And what this is about is to solve a hard computation and then prove that you solve this hard computation. What this allows us to do is having voting defined as what the majority of the CPU power wants to vote is the valid transactions. This means that as long as 51% of computing power stays honest, the system works. Now, what is this proof of work? The way you do it is by finding the right hash to a block. Now, what happens is that you have different nodes in the network being run, what we call the miners, and they're competing on finding this hash first. I'll explain later why they do that. So how does this work? Well, first, if we want to find the nonce, so say it's a number n for some block B, we start by setting it to 0 and then we increase it by 1. Now we check if we hash the block, is it below some value t? It's not really important to talk about exactly which value. This would probably vary. If it's not, then we increase n by 1. So you can see this is a loop that continues again and again and again. And each time we get to perform a hash, and this is time consuming. So it will take quite a lot of time and processing power to actually find the nouns that will create a block when hashed that is less than t. And when we do, that's when we have a new valid block to add to our chain. So if somebody wants to subvert the network and create a parallel track, they can do that. However, to avoid this, what we're doing in the Bitcoin network is we always consider that the longest chain is the valid one, and any side chain, it gets orphaned and disregarded. So if somebody wants to subvert the network, they have to hash much faster than the competition so that they can create a longer chain faster than everybody else. However, here's a very interesting design, which makes it so that people don't really have any incentive to subvert the network. You probably heard about Bitcoin mining and fees. Well, what happens is that when you find the block before anybody else, you get to do the very first transaction called the Coinbase T0. And from this transaction goes 25 Bitcoins, which the creator of the block can send anywhere. So essentially, it's 25 Bitcoins in profits to anyone who finds the next block first. In addition, one thing in my previous videos that I kind of papered over is that normally the transactions, when they send Bitcoins into new ones, so consider T1 and T2 that send Bitcoins into transaction T3, you can see that it doesn't all add up. We have 4.1 Bitcoins going into T3, and we have 4 Bitcoins going out. The remaining 0.1 Bitcoins becomes what we call the transaction fee. This will just go to the miner. Now, in principle, you can set this to whatever you want. You don't have to set it to anything. But this will mean that the miner, that is essentially the node that verifies transaction, has no incentive to verify your transaction. So you like to set the transaction fee high enough for your node or for your transaction to be considered. This can vary a lot. I think in the beginning of the existence of Bitcoin, it cost probably something 1 cent or something at the current trading rate of Bitcoins. And today this has shot up to something like $20 in transaction fees. And why does that happen? Well, as I said earlier, there's a limited number of transactions that can fit into a block, and each block is made every 10 minutes. So that means that when you have more transactions, people want to do more transactions that can actually fit in every 10 minutes. There's a competition for transactions to get in. So we get a supply and demand. We get a market, right? Where the demand to get in means outstripping the supply and the price goes up. So to jump the line and get your transaction into the block, what you have to do is you have to increase your transaction fee to squeeze out others. So you might think that with this approach that there'll be some issues. For instance, I heard people ask, well, won't get the blockchain get too large? It's also already a bit of a problem. It's several tens of gigabytes last time I checked. It's probably larger now. And the other problem is that since it takes 10 minutes to create a block, and we need something like 6 blocks to make sure that the network isn't getting subverted and we're having a sort of an alternative chain. If we're having 6 blocks, it, computationally speaking, becomes a sort of impossible problem always for somebody to subvert that and have enough computation power to get past it. So for larger transactions, we typically consider that the transaction time is about an hour because we need 6 blocks created after the block that we had our transaction in. However, there is a way around this. It's called the Merkle Tree. And this is based on the fact that we don't actually store, or the hash of an individual block is not actually dependent on the transactions themselves, but rather a hash of the transactions called H1. And this hash is created by a tree, so you can see that the H1 hash, which is stored in B1 in this case, is created by concatenating hash H1 and H2 and then hashing that. And H1 again is created by concatenating H3 and H4 and hashing that. And then H3 is a hash of transaction 0 and H4 is a hash of transaction T1 and so on. So the way you can use this is if a merchant wants to check if some transaction T2 is valid, it doesn't have to get all the transaction data. It doesn't have to wade through all transactions in, say, B1 to check if T2 is there. Instead, what he does is he creates a hash of T2, and then he has to acquire the H6 hash, and then he can create the H2 hash by concatenating these two, and by acquiring H1 and concatenating that with H2, we will get the H0, and we can just compare this one with the one stored in B1. So it means that you need a lot less data transmitted to check if a transaction is in the tree. Obviously, this is not quite as safe as waiting for 6 blocks to be created. An important thing about this approach means that to save space in the future, we could, in theory, remove the transactions in the blocks and only keep the hash. It will not invalidate the blockchain. Now let's do a recap of what I talked about. So the blockchain, the whole point of it is to solve the double spending problem, to make sure that people don't try to spend their money multiple times in transactions to different people. It works by using proof of work, where proof of work is used to vote on and validate transactions. And the whole system is designed to appeal to people's selfish nature by making it, giving you a financial reward for staying honest and not trying to subvert the network.